Ladies and gentlemen, thank you for standing by and welcome to the Graphic Packaging fourth quarter and full year 2019 earnings call. At this time, all participants have been placed in a listen-only mode and the floor will be open for your questions following the presentation. If you would like to ask a question at that time, please press star 1 on your touch-tone phone. If at any point your question has been answered, you may remove yourself from the queue by pressing the pound key. We ask that while posing your question that you please pick up your handset to allow optimal sound quality. Lastly, if you should require operator assistance, please press star 0. I will now turn the call over to Melanie Skegis, Vice President of Investor Relations, to begin.
Good morning and welcome to Graphic Packaging Holding Company's conference call to discuss our fourth quarter and full year 2019 results. Speaking on the call will be Mike Doss, the company's President and CEO, and Steve Scherger, Executive Vice President and CFO. To help you follow along with today's call, we have provided a slide presentation which can be accessed on the investor section of our website at www.graphicpkg.com. I would like to remind everyone that statements of our expectations, plans, estimates, and beliefs regarding future performance and events constitute forward-looking statements. Such statements are based on currently available information and are subject to various risks and uncertainties that could cause actual results to differ materially from the company's present expectations. Information regarding these risks and uncertainties is contained in the company's periodic filings with the Securities and Exchange Commission. Undue reliance should not be placed on forward-looking statements, as such statements speak only as of the date on which they are made, and the company undertakes no obligation to update such statements except as required by law. Mike, I'll turn it over to you.
Thank you, Melanie. Good morning, and thank you for joining us to discuss our fourth quarter and full year 2019 results. I am pleased with where we finished the year, having delivered on or exceeded the targets we established on our fourth quarter 2018 results call. We drove profitability improvement in 2019 primarily by our pricing actions and productivity initiatives. Our EBITDA and cash flow performance met our raised targets for the year, and we created shareholder value by executing well and effectively allocating capital. Importantly, our strategic initiatives are positioning us to achieve the growth and return goals we established in our September at our Investor Day with Vision 2025. In 2019, we achieved many milestones that position us for the next several years. We fully integrated the SBS mill and food service assets, successfully achieving run rate synergies of $75 million at year-end. The Letic acquisition increased our mill to converting integration, and we see continued opportunities to increase integration rates and improve profitability across our SBS and food service. In 2019, we announced and made strategic investments in our integrated CRB platform that will further strengthen our position in the marketplace. The CRB transformational investment in Kalamazoo is underway and on track for an early 2022 startup. Our CRB platform will significantly benefit from scale, state-of-the-art automation, and technology. We expect to generate $100 million in annualized EBITDA improvement upon the full ramp by the end of 2022. In addition, during the year, we successfully completed the Artistic Carton acquisition, which expanded our market participation in growing segments. Our CUK production in 2019 outpaced the industry, and we achieved full-year volume growth of over 2%, driven by strong global demand for CUK in beverage packaging. Europe continued to accelerate, driven by sustainability-supported growth of paperboard multi-pack beverage solutions as a substitute for other forms of. Orders for our proprietary Steel Clip solution continue to meet the expectations we established with Vision 2025. Our investments in the Monroe facility in the U.S. and our Snake facility in Europe fully support the organic volume growth trajectory we see for beverage packaging solutions in CUK paperboard for the next several years. Turning to the fourth quarter, we reported solid operating and financial results with volume up 2.6% and net volume up 0.7% on a year-over-year basis. Adjusted EBITDA of $259 million improved $11 million from fourth quarter 2018 and was in line with our expectations. Adjusted Adjusted EBITDA margin of 17% improved 60 basis points from the same period a year ago. Net organic volume growth, while a positive 20 basis points, was below our 100 basis point growth target for the fourth quarter as a significant customer conversion to our paperboard solution was delayed by 1 quarter. The conversion was fully ramped at year-end. We continue to expect 100 to 200 basis points of sustainability-supported net organic volume growth in 2020 as a result of multiple conversions to paperboard solutions already committed to by our customers. The fourth quarter benefited from continued positive pricing of $25 million, with our pricing to commodity input cost relationship a favorable $31 million as we experienced net commodity deflation of $6 million during the quarter. For the full year 2019, financial results met our raised expectations. Net sales of $6.2 billion grew 2.2%, driven by $131 million in pricing and $50 million in volume mix, primarily from acquisitions. Full-year adjusted EBITDA of $1.03 billion increased $59 million, or 6.1%, from the prior year, and was driven by a $98 million positive price to commodity input cost relationship and $74 million in improved performance. 2019 adjusted EBITDA margin of 16.7% improved from 16.1% in 2018. We generated significant cash flow during the year with $528 million in adjusted cash flow, an increase of $59 million from 2018. Steve will discuss our financial results in greater detail during his prepared remarks. Moving now to operational trends in the quarter. Our mills and converting assets ran well during the quarter and for the full year. We successfully executed on multiple large-scale capital investments, including the Texarkana recovery boiler and the final ramp of the large Monroe converting facility. We are positioned well to service new volume opportunities in 2020 and beyond. We will continue to provide customers with the highest service and quality levels consistent with their expectations. For the fourth quarter of 2019, the AF&PA reported operating rates of 97% for CRB and 92% for SBS. Graphic Packaging CUK operating rate remains above 95%. Backlogs remain healthy at 5+ weeks for CUK and balanced at 3 to 4 weeks for CRB and SBS. Shifting to performance. We achieved $74 million of operating performance in 2019. This solid improvement in productivity was partially offset by $36 million in incremental incentive and pension expense. Our continued emphasis on improvement initiatives, operating cost efficiencies, benefits from capital investments, and synergy achievement drove strong performance for the full year. Let me now focus on our capital allocation priorities. Our strong cash flow generation and solid balance sheet provides us with the financial flexibility to deploy a balanced approach to capital allocation. We executed well in 2019 and will continue this focus in 2020. During 2019, we returned $242 million to stakeholders through dividends, distributions, and share repurchases, paid $53 million for the Artistic Carton acquisition, and invested $353 million of capital back into the business, including an initial $23 million outlay to support the transformational Kalamazoo CRB investment. Focusing briefly on the 2020 guidance, we expect 2020 adjusted EBITDA will be in the range of $1.05 to $1.1 billion and adjusted cash flow to be in the range of $200 to $275 million. As we shared with you as part of our Vision 2025, the global shift to paperboard packaging solutions, coupled with our significant new product development activities, is driving demand and provides us with confidence we can capture the 100 to 200 basis points of sustainability-supported net organic volume growth in 2020. In the fourth quarter, we ramped up several U.S. customers into paper cups from other substrates. We have also shipped our first KeelClip packaging machine to a customer in Europe, and we are seeing increased interest from customers in North America. our organization is relentlessly focused on capturing paperboard conversion opportunities, and I am encouraged with our momentum as we enter 2020. Finally, let me take a moment to discuss three important announcements we are also making today, along with our 2019 highlights and results. First, International Paper notified us of their intent to begin the process of reducing their ownership interest in our partnership. Per the agreement, we will be purchasing approximately 15.1 million partnership units from International Paper for $250 million later this week. The purchase will be funded from our domestic revolving credit facility and will result in a reduction of IP's ownership in the partnership from approximately 21.6% to 18.3%. As you may recall, IP can redeem $250 million of partnership units every 180 days per our agreement. We are very pleased that our 2018 transaction with International Paper is playing out as originally intended, creating value for our customers and stakeholders while building a leading integrated paperboard packaging platform. We appreciate the confidence International Paper placed in us to build and grow the business and look forward to creating value for our stakeholders for years to come. Second, we are announcing the settlement of approximately $900 million in obligations for our largest U.S. pension plan through lump sum payments and the transfer of the remaining pension obligation to an annuity provider. The lump sum payments were completed in Q4, and the transfer of the benefit obligations to the annuity provider will take place in Q1 2020. I am very pleased with this outcome for our retirees, our pension participants, and graphic packaging. Finally, we are announcing the acquisition of a folding carton facility from Quad Graphics for $40 million. This strategically located, well-capitalized folding carton facility in Omaha, Nebraska, conveniently serves customers across the Midwest. The converting operation consumes approximately 40,000 tons of paperboard annually and will contribute an estimated $7 million in annualized EBITDA, including synergies, over the next 24 months. With that, I'll turn the call over to Steve for a more detailed discussion on our financial results. Steve?
Thanks, Mike, and good morning. We reported fourth quarter earnings of 11 cents per diluted share, compared to 15 cents in the fourth quarter of 2018. Fourth quarter 2019 net income was negatively impacted by a net $34 million of special charges, including a non-cash pension plan charge associated with the settlement process for our largest U.S. pension plan. Fourth quarter 2018 net income was negatively impacted by a net $21.9 million of special charges, including a charge related to the extended outage at our Augusta SBS mill. Details can be found in the reconciliation of non-GAAP financial measures table attached to the earnings release. When adjusting for these charges, adjusted net income for the fourth quarter was $67 million, or 23 cents per diluted share. This compares to fourth quarter 2018 adjusted net income of $69.4 million, or 23 cents per diluted share. For the full year 2019, we reported earnings of 70 cents per share, compared to 71 cents per share in 2018. Net income in 2019 and 18 were negatively impacted by a net $48.9 and $30.2 million of special charges. When adjusting for these items, adjusted net income in 2019 was $255.7 million, or 87 cents per diluted share. This compares to adjusted net income in 2018 of $251.3 million, or 81 cents per diluted share. Fourth quarter 2019 adjusted EBITDA increased $10.7 million from 2018 to $258.8 million. Adjusted EBITDA was positively impacted by $25.5 million of higher pricing, $5.7 million in deflation, primarily secondary fiber and energy, $4.8 million in improved operating performance, and $1.6 million of favorable foreign exchange. These benefits were partially offset by $15.4 million of unfavorable volume mix and $11.5 million of other inflation, primarily labor and benefits. Full year 2019 adjusted EBITDA increased $58.9 million, or 6.1%, from 2018. Adjusted EBITDA was favorably impacted by $131.2 million of higher pricing and $37.9 million of improved net operating performance. These benefits were partially offset by $46.4 million of other inflation, primarily labor and benefits, $32.7 million of commodity input cost inflation, primarily wood and external board, $22 million of unfavorable volume mix, and $9.1 million of foreign exchange. We ended 2019 with over $1.7 billion of global liquidity and $2.7 billion of net debt. Total net debt decreased $200 million during the quarter. Net leverage was 2.6 times at the end of 2019, at the lower end of our targeted 2.5 to 3 times range. Moving to our 2020 guidance, as Mike referenced, we expect full-year adjusted EBITDA to be in a range of $1.05 to $1.1 billion. Key drivers of the adjusted EBITDA guidance are $30 to $40 million in positive pricing, partially offset by $20 to $30 million of commodity input cost inflation, and positive volume mix of $15 to $25 million. We expect performance improvements of $65 to $75 million. We'll offset higher labor, benefit, and other expenses, primarily insurance and property taxes, of $50 to $60 million. 2020 adjusted cash flow is expected to be in a range of $200 to $275 million. The reconciliation from adjusted EBITDA to cash flow includes $600 to $625 million in capital spending, $140 to $160 million in cash interest, $30 to $40 million in cash taxes, $10 to $30 million in working capital, and $10 to $20 million in pension contributions. Following up on Mike's comments on our partnership with International Paper, assuming IP continues to reduce its ownership interest per the agreement, we do not expect to be a material U.S. federal cash taxpayer until 2024. For 2020, we will be providing adjusted EBITDA and cash flow guidance for the full year and intend to provide updates to the annual guide during quarterly reports when necessary. We will not provide specific quarterly adjusted EBITDA guidance in 2020, and instead we'll be providing our expected year-over-year impact to EBITDA from major maintenance-related events in our detailed guidance, which is available on slide 10 of the earnings presentation available on our website. The annual view is consistent with how we operate the company and is in line with the long-term goals outlined in Vision 2025. Additional guidance details are included in the presentation on our website. Thank you for your time this morning, and I'll turn the call over to the operator for instructions on Q&A. Thank you.
Thank you. At this time, I would like to remind everyone, if you would like to ask a question, please press star, then the number 1 on your telephone keypad. If your question has been answered and you wish to remove yourself from the queue, press the pound key. We ask that you please limit yourself to one question and one follow-up only, and return to the queue for any additional questions. Your first question will come from the line of Mark Wilde of BMO Capital Markets.
Good morning, Mike, Steve, Melanie.
Morning, Mark.
Morning, Mark.
I wonder for my first question, if Mike, can you just help us with how you're seeing kind of supply demand in the box board markets right now, especially SBS? It seems like there are at least 2 or 3 big moving parts there with the GP closure, the Finnish strike, and the new entrant.
Yeah, I think you summarized it actually pretty good, Mark. I mean, our overall demand, as you saw, held up well in Q4 in terms of the key markets that we service. And to your point, I mean, a major competitor shut down a mill effectively October 1st on the SBS side, and at the same time, we've got another competitor, a new entrant that's ramping up. And best information we have is that'll be a year-over-year increase of about 100,000 tons versus the 360 that came out of the market. So we would still expect to see, that to be positive on operating rates, probably a couple quarters into the year. It usually takes a little while for that inventory to kind of completely move through the system. It's been our experience at least. So we're going to continue to watch that and monitor that and see how that all plays out. The other grades, as we talked about, our CUK, it's a little hard to see that now because it's commingled with the gypsum, wall facing board, but our operating rates are above 95%, as we said, and global demand for that remains very strong. driven by a lot of the beverage sustainability packs that we're talking about. We referenced a few of them on our call today, and that's part of our look forward on our 100 to 200 basis points growth that we believe that we can drive here in 2020. And CRB's been stable. I mean, I know the backlogs are down year over year, but that's really more of a function, as we talked about, is in 2018 they got too long and we weren't doing a great job servicing our customers, and so we're doing a nice job, having the inventory where we need it now to be able to take care of those customers, and operating rates on CRB last year were very strong at 97%.
Okay, and then for a follow-on, I just wondered if we could get a little more color on the Quad Graphics deal, because it looks to me like if you're saying with synergies you're going to get that business up to $7 million in EBITDA, that it must be essentially break even or maybe just a little above break even right now. So I'm curious, when you think about that synergy number, is that just most of that just pulling more board volume through your mills into that carton plant? And is there any way to actually improve profitability at the carton plant itself, either through kind of changing mix, changing price, et cetera?
Yeah, thanks for that question. We're excited about having that facility join our business, those employees join our business. Look, the strategic location of that facility is excellent, Omaha, Nebraska, to service our Midwestern customers. So we'll start with that. That helps us optimize our business mix, across the Midwest platform for some savings from freight standpoint, both on board and on servicing customers. We do run a big system up in the Midwest, so we've got the opportunity to balance that across a larger platform. So there's some synergy opportunities there as well. And this facility is very well capitalized. So the printing and cutting and gluing equipment in this location are excellent. And the other part of that I'd add, and you referenced this, is it pulls 40,000 tons of paperboard, the majority of which is CRB. And the investment we're making in Kalamazoo there, where we're going to have the better part of $130 a ton advantage there. So when you put those things all together, both on the converting and on the mill side, it really makes sense why that is a nice bolt-on acquisition for us.
Our next question comes from the line of Mark Connolly of Stephens Inc.
Hey, good morning. This is John Ryder on for Mark.
Hi, John.
So as we see trends towards more sustainable products continue to evolve, has your view shifted on which grades specifically will see the most benefit?
No, not really, John. I think if you look at what we've been seeing and what we've messaged, we expect CRB to be relatively stable. There might be some growth opportunities as we have a higher quality sheet and come out the other end of our investment we're making in Kalamazoo. So that probably is a net slight positive for us. But then the CUK, we expect that to continue to grow, both domestically and internationally, and that was our experience last year as well. And we expect the SBS segments where we compete, and specifically that's folding carton and food service, and a little bit of liquid packaging, to be actually slightly up. And that's offset by a few of the other segments of the SBS market that are a little bit pressured, specifically tobacco packaging and some of the exports there. So and it's completely in line with the view that we've got relative to our 100 to 200 basis points of growth we expect to achieve here in 2020.
Yeah, and John, to Mike's point, specifically in 2020, we'll see that 100 to 200 basis points of growth primarily coming from the CUK and SBS grades, driven by those very specific conversions, beverage conversions from plastic into paperboard, cup conversions from other substrates into paperboard, and other bowls and trays. So those three categories will drive it mostly through the two virgin paperboard grades.
Okay, that's helpful. And then if you guys could just kind of give a brief update on what's happening with the Snake facility.
Yeah, so the Snake facility is, for description purposes, a smaller version of what we're doing in Monroe. It's the same equipment that we're putting in there, just on a much smaller scale. So we're going to have a global platform to service our beverage customers on that's unique and different than really anybody else in the space. And if you think about it, we tend to service, the large, beverage companies, and to be able to have that balance and that international platform that's consistent gives us unique ability to compete for that business and service those customers. So as we referenced in my prepared comments, the Monroe facility is pretty much at full ramp rate as we head into 2020. Snake will be a little bit behind that. We expect the second half 2020 to be really at almost full run rate there. So it's kind of a complete system that we've got across the globe.
Our next question comes from the line of George Staphos of Bank of America.
Hi, everyone. Good morning. Thanks for all the details. I want to ask my first question largely around, volume trends. Can you talk a little bit about what might have caused the customer delay, although these things are normal when you have conversions, and what effect that might have had on the volume mix number? And relatedly, given the success that you're speaking about in terms of winning these conversions, are you seeing other substrates, Mike, fighting back a bit more aggressively to regain share or perhaps even grow their share? What are your thoughts there?
Hey, George, it's Steve. Just to address the first part of the question, then Mike can add on. Specifically, this modest kind of one-quarter delay was just related to a large nationwide rollout, and the customer itself got into a position where they just weren't able to migrate the volume as quickly as expected. But as we mentioned, it is fully ramped by year end. We believe that it had, just a little more than a 50, 70 basis point impact on the quarter, and so we were really heading towards that 100 basis points, and then it's just a natural delay with our customer, not in terms of our ability to service it, played out, but it's now fully ramped. And Mike touched on the other piece.
Yeah, just to build on that, and from Steve relative to other substrates fighting back. Look, these are mature markets, and we expect that we're going to have to compete for the business and the volume every day. Specifically, as it relates to cold cups, we do see some regional activity where there are some plastic options that are being trialed and explored. And look, we're not going to win every jump ball along those lines, and we've been very straightforward in that, and that's all factored in our 100 to 200 basis points that we're putting out there of growth that we expect to achieve. We are actually winning more than our fair share on the hot cup side, where plastics really isn't an option if you think about it, or as big of an option. So I think that's how I'd ask you to think about it, George. It's a balanced view of what we think is possible and very targeted to the products where we with something that they desire and an advantage.
Yeah, no, that all makes. Go ahead, Steve. I'm sorry.
Yeah, just concluding that to Mike's point is for 2020, these are known conversions with known customers. I think that's what's critical to our confidence in the 100 to 200 basis points.
Understood. No, and I appreciate the thoughts on that. The other question I had, just if you could go over, if I missed it, apologies in advance, but if you could go over what's in your price cost guidance in terms of assumptions on nat gas, chemical and resins, recovered paper. Thank you, and good luck in the quarter.
Yeah, George, it's Steve. Just regards to price, the $30 to $40 million is a flow-through of pricing actions that we've taken, known movements that will occur. So there's nothing new information. It's all information in the marketplace relative to previous announcements and the flow of our contracts with customers. With regards to the $20 to $30 million of commodity input cost inflation, it's on a basket of about a $2.5 billion spend, and it's a 1% increase, lowest in many years. But overall, the midpoint is a 1% assumption across that basket. Don't want to get into the specifics by line item because we don't know what will run this year. We think we're making a very appropriate assumption for pretty modest inflation of roughly 1% across that $2.5 billion spend.
Yeah, I think, George, just to put a little finer point on Steve's comments relative to why we're not going to give specific individual commodity assumptions is if you take a look at oil for a minute, 2 weeks ago, based on geopolitical tensions, it was closer to $60 a barrel. Yesterday, it was $50. So
Right.
these things move around, and so what we're telling you is we think we will have modest level of input cost inflation. We're not sure exactly where yet because it's really only at the end of January, but that's our assumption.
Okay, that's great. Thank you, guys. I'll turn it over.
Yeah, thanks, George.
Your next question comes from the line of Ghansham Panjabi of Baird.
Hey, guys. Good morning. I guess my first question on the volume mix that you cited in 4Q as being unfavorable, can you just give us some color as to what exactly that was due to? And then just following up on George's last question on the delay 4Q into 1Q, should we sort of look at the benefit on 1Q as being 80 basis points because you came in at 20 basis points of growth in 4Q and you cited that being below your 100 basis points target? Is that the right way to think about it for 1Q?
Yeah, Ghansham, it's Steve. A couple of things there. With regards to Q1, we would expect to be in our 100 to 200 basis points for the quarter, and so our expectations will be is that we will be within our 100 to 200 basis points for the quarter. With regards to Q4 volume mix, and it is relevant, some of the negativity is things we've been working through here throughout the year in terms of the onboarding of significant volume and some of the mix changes we've seen in places like Big Beer, but more importantly, the onboarding of the significant volume has some negative volume mix as we're working to earn on it. We fully expect, as you've seen in the guide, to also positively begin to earn on volume mix in Q1. The number in Q4 was a little larger than normal because we had a bit of an unusual comp at the end of 2018. We had a very large amount of volume of open market paperboard that was a bit of a one-time event that we sold into the marketplace that didn't repeat in Q4. And so that was a bit of a specific comp. And so again, just repeating it, we expect Q1 to be in the 100 to 200 basis points and expect to begin to earn positively on that volume mix in Q1.
And I think, Ghansham, the other thing I would add, if you think about what we have been able to do on the pricing side, if you take a look at what we're forecasting here for 2020, you add it up, it's $250 million worth of pricing that we will have achieved over about a 3-year period of time. We also shrank our lag time from 9 months to 6 months. And you don't do that, as you know, without putting some business at risk. And that's, in fact, what we did. But we've got a lot of confidence as that being the setup as we head into 2020, as we've talked about, that we did all that and we've got this growth trajectory that now we'll be able to earn on. So that's how I'd ask you to think about it.
Okay, and for my second question, kind of putting 2019 in perspective, right? So you came in at 16.7% EBITDA margin. In 2015, you were at 18%. The only big portfolio move is really the SBS. How much of that was, how should we sort of bridge that margin gap, and what are the big drivers of that?
So I guess the first thing is that, the SBS platform came in at like 13.1%. So, that would be, a bit of the math that you'd have to, factor into that. We delivered on the $75 million worth of savings as a run rate number, so that's flowing through. You saw the step up, last year from 16.1 and 18 to 16.7. In 19, and if you take a look at the guidance that we provided here, for the full year 2020, we expect to continue to expand that.
Yeah, and Ghansham, just adding to Mike's point, the prior to the onboarding of the SBS and Cup business, the core business prior would be moving back towards those margins that you just articulated. With now SBS moving from 13s into the low mid-teens, and that's where as we've talked before, where last year we saw a fair amount of the inflation, and it's a place where we know that there's still opportunity to improve that return profile, to get it to at or above cost of capital returns, and that's a big part of the prioritization for 2020 as well in terms of the overall performance of that part of the platform.
Thank you.
You bet.
Our next question comes from the line of Chip Dillon of Vertical Research.
Good morning, everyone. Thanks for all the details. My first question has to do with the, and I might have missed any opening disclosures, but can you talk a little bit about the process of buying in the stake that IP has, and in particular, did they ask for you to buy all of it? And secondly, what is sort of the financing arrangements? Let's assume it is put to you every 6 months. Do you have a revolver that can handle the $250 every 6 months?
Yeah, Chip, it's Steve. With regards to this $250 million that we'll execute on, that we announced today and we'll execute on tomorrow, really that's just per our contractual agreement. And so we have the ability, they have the ability to pursue $250. We executed on it, leveraging our revolver. As we mentioned in the remarks, we have a $1.4 billion U.S.-based revolver, which is where most of this will apply. So we have plenty of capacity to do this move, as well as if there was a next one in July, that we could pursue that as well. We'll look at the debt profile of the company this year as well to determine what mix we'll have in terms of the permanence of the financing, but a lot of confidence that our balance sheet is in a good spot to do this year. And you've probably done the math. If you look at the guidance that we're providing, the guidance we're providing does assume that the second $250 million will take place. It's assumed with that guide, the 140 to 160 of cash interest expense. And if you kind of fast forward through, we'd still be within our 2.5 to 3 times leverage range, probably at the higher end of it, assuming we would execute on the second 250 if that occurred in the same scenario, the same fashion that we're doing this 250.
Okay, very helpful. And quick follow-up. One of the slides mentioned the sort of compressed timing of moving pricing, vis-a-vis costs from 9 to 6 months, which is certainly a big improvement. Is there an ultimate goal, and what would be a practical goal in terms of even further narrowing, if that's possible?
No, Chip, thank you for that recognition of that. But I mean, from what we've said, and we covered this at our Investor Day as well, I mean, that was our target, and that's where we're at. So 6 months is, again, how we'd ask you to think about it, and that gives us a couple moves every year, so we're not dragging inflation out of one year into the next, which was our goal, and we're there now. So that's where we're focused.
Understood. Thank you.
Our next question comes from the line of Anthony Pettinari of Citi.
Good morning.
Hi, Anthony.
Hey, Mike, China announced a single-use plastic ban over the weekend that seemed very focused on food service, and I'm just wondering, do you see any potential for this to kind of tighten the global market, either for SBS or CUK, either in the near term or the long term? I know China's not a major market for you, but I'm just wondering if there's any potential knock-on effects.
I think it's consistent with the view we talked about at our Investor Day in terms of the trends we're seeing globally. Certainly we see that acceleration in Europe we talked about, Anthony, and now China's adding to that. And as we mentioned, we've got a lot of opportunities here in North America that we're working on, specifically in a number of the product lines that Steve and I have already outlined here. So it's kind of consistent with our view.
Okay. And then just, you've given the quarterly outage guidance for the year, and I'm just wondering, when you step back and look at 2020 kind of from a big picture, what you view as maybe potentially the biggest sources of execution risk, and then looking at performance improvements, what could drive, I guess either downside or upside to your target?
Yeah, thank you for that. So the biggest, year-over-year change is, and we talked about this on our Q3 call, is we've got a recovery boiler that we're going to do significant maintenance on in Monroe, in West Monroe. That'll take place in Q2. And so on a year-over-year basis, it's not going to have a huge impact on our EBITDA because we've done Texarkana, as you know, last year. And as we said on our Q3 call, to the best of our knowledge, based on the testing that we've been done and the inspections that we've done, this is the last major recovery boiler work that we need to do for the better part of about a decade. And so that certainly is something we've got to manage well. We've built inventory to allow us to be able to take care of our business during that period of time. So you see that in some of our inventory numbers as we finish 2019. But we're set up well, we believe, based on the planning that we've done to take care of customers during that period of time. And I think the other thing that we'll continue to benefit from here in 20 is, we started up a facility in Monroe, that big converting facility that many of you had a chance to visit, and on a year-over-year basis, we would expect to drive a significant amount of productivity, with that asset, and that's in fact how we've developed our plans for the year. So those two things are probably the biggest things that are on our mind.
And Anthony, just in terms of the new information we're providing on year-over-year net maintenance outage costs, the intent there is to provide you with some facts around what's occurring in terms of what quarters versus the prior year. And as you can see from the information, Q1 is pretty neutral, and so natural improvement will just occur in the business consistent with our guidance improvement. Whereas Q2, a lot of what Mike just articulated is taking place in Q2 this year rather than it being spread more in Q3, Q4. So on a year-over-year basis, we'll experience a fair amount of that maintenance-related expense in Q2, tapping down the EBITDA in Q2 with more material improvement in Q3 and Q4 on a year-over-year basis. So the year will flow a little different than last year. We're trying to provide a little bit of transparency into how the business will function given these large maintenance activities that we undertake annually.
Got it. That's very helpful. I'll turn it over.
Our next question comes from the line of Debbie Jones of Deutsche Bank.
Hi, good morning. My first question is on the volume outlook for next year. It does seem that there is one customer driving a significant portion of it, so I'm curious, is it a handful of customers that drive the balance to get you to the 100 to 200 basis points of improvement? Are we talking about, 50 or more? I'm just trying to understand really how many conversions are happening with your customers, and then, as you sit here today, do you think your conversations about potential future conversions are increasing or about, the levels they were maybe like a year ago?
Yeah, Debbie, it's Steve. I'll kick that off. The $15 to $25 million of EBITDA improvement year over year, it does have a little bit of the acquisition that we just talked about from Quad in there, so that'll be volume related. But it's a wide variety of customers. There are the large recognized customers that you'll talk about that we've talked about before, the Dunkin' Donuts or large beverage customers with conversions to Keel Clip. So those will get the headlines, but really across the enterprise, we have small, medium, and large conversions happening in those categories: beverage conversions, cup conversions, bowl plate conversions. So it actually spans small, medium, and large. We'll tend to talk about it more, though the headlines we'll read with some of the big ones. But we're pleased with the fact that it actually is kind of spanning across the enterprise, small, medium, and large customers.
Okay, thanks. That's helpful. My second question, are you able to just update us on your recycled fiber exposure, the 1 million tons? Are you changing anything about the mix of recycled fiber just due to where pricing is right now? And anything else we should consider in your outlook related to recycled fiber? At the very least, are you able to tell us if you expect pricing to move higher year over year?
Yeah, in regards to any pricing moves, that would be contained in the guide that Steve kind of took us through, Debbie, relative to input cost inflation. It's bouncing along the bottom right now. Could we see a little bit of an uptick, given that? Yeah, we think that could happen, but we don't know for sure. But what we are doing is, with the investment we're making in Kalamazoo, is we're going to have the most modern, state-of-the-art cleaning systems there. So we'll be able to take an increasingly lower quality grade of material and turn that into, high-quality paperboard. And so the investments we're making will, in fact, help us be able to do that over the long term, medium and long term. And we think that's the right investment for us to make.
Okay, great. Thanks. I'll turn it over.
Our next question comes from the line of Brian Maguire of Goldman Sachs.
Hey, good morning, guys. Just wanted to go back to the delay and the customer delay. I appreciate it was only a one quarter delay, but it seems like it might be having a negative impact on the stock today. So just wanted to clarify your comment there, Steve. Are you saying that in January so far you're kind of already back in that 100 to 200 basis point volume growth range that you kind of always talked about for 2020? So as you kind of sit here in 1Q, we're kind of already at that targeted targeted range?
That's correct, Brian. Just to repeat that for you, the 100 to 200 basis points that we have line of sight to for 2020, we see line of sight to that in Q1.
And I apologize if I missed it in the prepared remarks, but I think normally you gave some color on the forward quarter EBITDA guidance. Did I miss it, or are there any comments you have on 1Q kind of EBITDA?
Yeah, Brian, it was just at the end of the prepared remarks, but we are this year, we're going to move to an annual guide with regards to EBITDA and cash. What we're providing is what we just talked about a moment ago, which is visibility into our year-over-year maintenance-related outage costs, which will provide you with the appropriate line of sight into how the quarters will likely play out as you look at prior year EBITDA, this year's guidance, and kind of the flow-through of how maintenance costs will provide. So we're substituting it with a little more information that's granular on maintenance costs and moving away from a quarterly specific guide relative to EBITDA.
Got it. Yep, sorry, I missed that. And just on the pension, last thing from me, just on the pension, just kind of a question on why the decision to do this now, and didn't sound like you were talking about any cash impacts to GPK from that. I'm assuming you're just transferring some assets from the pension fund itself, but could you just kind of confirm that and any impact it could have on your own cash flows in the 2020 or in forward years?
Yeah, thanks, Brian. In terms of this $900 million that we've settled, this has really been a 5 to 7 year journey actually towards immunizing and then eventually getting to a place of fully funding and removing the liability, moving it into an annuity provider. So it's really been a long journey, and it all culminated here at the end of the year and here in January, and so hence a very good outcome for our retirees. Associated with that $900 million, there are no cash implications of that in 2020. It's fully funded, and so there'll be no additional cash requirements. The cash that we're putting into our guidance is our ongoing remaining pension plans that we have around the globe, about $500 million around the planet that we continue to support financially. They're all very well funded, but that 10 to 20 is just now in kind of the normal course.
Got it. Thanks very much.
You bet.
Your next question comes from the line of Arun Viswanathan of RBC Capital Markets. Arun, your line is open. Please state your question.
Sorry about that. I was on mute. Sorry about that. Good morning, guys. I guess my first question is around pricing. Looks like you have the flow-through benefits of 18 and 19, still flowing through in 2020. You cited kind of mid-90s operating rates in CRB and CUK. Do you think there's any opportunities to go after further pricing in those two grades? I know that you're still working through the inventories in SPX, but I'm just curious. It seems pretty tight in those two grades, and if there's any opportunity to take further pricing. Thanks.
So, Arun, thanks for your question. I guess, as you know, we're not going to talk about future pricing actions, on a call in terms of what we would or would not do. Having said that, we're very focused, as we've talked about, in terms of the operating rates and driving our integration levels up. Today's acquisition, this tuck-in acquisition, continues to build on that strategy to drive our integration levels across all three grades up, which helps us, drive and optimize our overall mix. And so I'd ask you to kind of just think about that continuation. We did, a tuck-in acquisition last year with Artistic Art, and we've done another one now here in Q1. And that's really where we're placing our emphasis, in addition to our new product development activities that are driving, 100 to 200 basis points growth, and we'll continue to pull paperboard through our low-cost integrated, platform.
So just to clarify, is there an opportunity? It sounds like there is an opportunity for continued mix improvement as you increase those that integration level. Is that right?
Yeah, that's right. I mean, the mix certainly improves as we continue to drive it through our own converting operations, and it kind of smooths out the demand profile. So it helps us optimize our EBITDA and free cash flow, and that's why we like that as one of our keys.
And is that mix captured in your price outlook, or would that be additional upside?
It's in the volume mix outlook, the 15 to 25 million.
Great. And then just lastly, just on the change in IP's ownership, I was just curious. It seemed like there was potential for them to remain owners for a little bit longer. Was there any? Are you aware of any changes in their view of their ownership of the GPK stake? Did that change over the last couple of months, or was it very relatively consistent with their communication with you?
So I think you're going to have to ask that specific question of International Paper, but I can tell you from a graphic packaging standpoint, this played out the way that we planned it to play out, and what we talked about with our Vision 2025. We're very happy to have the SBS and food service platform integrated into our company. If you think about what we've done over the last 2 years, we've drove integration up substantially by integrating our outside purchase of SBS. We've done a couple of tuck-in acquisitions, including a major one with Letica, to take those integration rates up. We drove the synergies that we said that we were going to drive at $75 million and created, shareholder value. So, as they're looking at it, I'm sure they're thinking about it as a capital allocation decision, and that's something better left for them to answer than me. But from a graphic packaging standpoint, we're very pleased with how this has played out.
Okay, I'll turn it over. Good luck in the year. Thanks.
Thank you, Arun.
Our next question comes from the line of Adam Josephson of KeyBanc Capital Markets.
Hey, good morning. Thanks, everyone. Mike, one on hot versus cold cups. You talked about that earlier, but I know you mentioned Dunkin' Donuts and is a prominent case of a customer going from foam to paper. On the cold cup side, you talked about some customers or some companies trialing plastic. So it seems as if perhaps you have some customers on the cold side moving in the opposite direction as those on the hot cup side. So can you just talk about kind of why you think perhaps you're seeing those disparate situations?
Well, like I said, these are mature markets, Adam, and so we have to compete every day for the ability to supply our customers, and every customer's got their own set of objectives and marketing strategies that they're looking for, and how they want to build those brands, and so they make those decisions, based on a wide variety of factors. The outcome of that is, there are some opportunities for cold cups to go, on the plastic side, and we see that. And then, as you've seen, we've seen a lot of, the foam come into paper. So it's a balance.
Sure. And just on the Kalamazoo project, Mike, can you just give me an update on when you expect the 3 older machines to get shut before you bring the new machine on in early 22?
Yeah, so all of that will occur really in 2022. So if you think about it, there's actually 4 paper machines we have to take down. 2 in Battle Creek, 1 in Middletown, and then the 1 in Kalamazoo. And so we have to get the new machine up and operational, which we said we'll do in Q1 of 2022, and then get the trials done, the qualifications all complete, and then systematically ramp the other machines down as the new machine is qualified and brought online. So that is really a 2022 phenomenon.
And we'll do that, Adam, Steve, on a capacity neutral basis while that's happening. So we'll be ramping up, ramping down as we bring the asset in.
Thank you.
Your next question comes from the line of Daniel Rizzo of Jefferies.
Hey, just one quick question, guys. Thanks for taking it. So in the past, you mentioned that using price hikes to kind of recapture the lost or the higher costs of 16 and 17 and 18. I was wondering if you were able to do that, or if you're on trajectory to do that, or where we are with that that process.
Yeah, Dan, we appreciate you raising that. If you look at the roughly $125 million dislocation that occurred in kind of 2016 to 18 on price cost, with this year's positive $98 million of positive price cost, which exceeded our original expectations, we've now clawed back the majority. We're not all the way there, but we're within, $20+ million of clawing back that dislocation, and we'll get some additional, we believe, this year. So while it has been a journey that resulted in us compressing time lag so that we can do it faster, the model of being able to do so is intact, and we believe we will get into full balance here as we migrate through 20 and into 21.
And you've done a good job with compressing time lags. I was wondering if there's additional steps that you can take to even go even further, or it's just not possible at this point.
Well, look, we're always looking at that, but as I mentioned earlier, we're targeting 6 months and we're there. What I would say is we continue to build out our pricing to look at any forms of leakage on contracts, to look for those opportunities. Every year we get a little better on that. So that's really where our efforts are on the commercial side. It's really a big shift this year, Daniel, because we're focusing really driving this 100 to 200 basis points growth, and that's what our business units are actively engaged on. We see it, as Steve said, here in Q1, and we plan for it in terms of the inventory and where we've got our operations really positioned at. So that's a bigger focus right now than on the pricing side of it.
All right. Thank you very much.
Our next question comes from the line of Steve Shercover of D.A. Davidson.
Thanks. Good morning, everyone. If I'm not mistaken, in the South last year, you were dealing under kind of Noah's Ark conditions. So could you give us an update on where hardwood fibers are compared to last year and how that's incorporated into your commodity pricing?
Yeah, Steve, thanks for the visual. That's what it felt like. But as we went through Q3 and into Q4, things did normalize. We were able to build our hardwood inventories back, to levels that we hadn't seen really for the previous 2 years. So we like where we finished up the year and rounded into Q1 of this year. From an inventory standpoint, of course, it's always difficult to forecast what kind of spring we're going to have. But right now we feel good about where we're at, and we're seeing those prices for hardwood in particular, reflect that.
Okay, great. And as my follow-up, I think Mark Wilde kind of alluded to it. Some of the new business that you've brought on stream isn't particularly profitable until you get synergies incorporated. And I'm wondering, is there the same sort of dynamic with your organic growth? Are there startup expenses that kind of fade away and then the profitability increases once you're really operational for a period of time?
Yeah, Steve, it's Steve, and as we've articulated before, you're correct. I mean, we do have startup activities with good new business wins, have every expectation that those will be at the kind of margin profile that we have as a corporation, and we'll see that as we round into 2020. We went through some of that startup. We had a lot of starting up happening in 2019, both at the manufacturing level, bringing the Monroe facility to life, as well as making these conversions with significant customers. And we're very transparent about that in the numbers we share with you in terms of the volume mix implications that as we onboard. So that's where there's the confidence that the earning opportunity is there. We have very high confidence that the new products that we're bringing to life have a margin profile at or above the company.
Okay, thanks. Good luck to your head.
Thanks to you.
Your final question will come from the line of Mark Weintraub of Seaport Global.
Thank you. Kind of a follow-up, bringing together a number of the different questions. One of the things that's sort of just jumping out, obviously, was the 15 million negative volume mix year over year in the fourth quarter, and you've spoken to it. But I was hoping maybe to get a little bit more specific, because it was such a big outlier from what we had been seeing. And I know you'd referenced the open board, paperboard sales the prior year, and you can see in the fourth quarter last year you had a better volume number there. You've talked about the startup costs and those showing up, and perhaps the delay somehow shows up in the volume mix as well. Could you bucket approximate amounts for those numbers, just so as one can better understand the magnitude of that 15 million variance?
Yeah, Mark, of the 15, a little less than half would have been some of the new business transitions that we've talked about. A little less than half of it was the significant non-repeating open market paperboard sale, and the rest of it is very much approximate to where Mike was chatting earlier on us taking some good hard positions relative to price execution, all of which adds up to the quarter that we just articulated relative to volume mix, more importantly, the important pivot that happens as we round into 2020 on volume mix and earning on it, and that 100 to 200 basis points of net organic volume growth that we have line of sight to for the year as well as for Q1.
Great. And then as we look into next year, the startup volume mix, is that still going to be a drag or put more positively if we look at 2021? If there wasn't more startup coming on then, would there be a positive in 2021?
Yeah, I think that's probably difficult to estimate. We expect to be in a good, solid earning position in Q1 of 20, which would indicate really modest improvement as you go all the way out to 21.
Thank you.
Thanks, Mark.
Thank you. I will now return the call to Michael Doss for any closing comments.
Thank you for joining us on our earnings call. We had a solid year in 2019 and look forward to building on the momentum as we've entered 2020. We'll talk to you again in April to update you on our first quarter 2020 results. Thank you and have a great day.
Thank you. That does conclude the Graphic Packaging fourth quarter and full year 2019 earnings conference call. You may now disconnect.